Most people believe the next big financial crash will look exactly like the last one. A sudden collapse, stock prices crashing, real estate falling apart, panic everywhere. And then, finally, an opportunity to buy everything cheap again. That story feels familiar. It feels logical. And that's exactly why it's dangerous, because what's coming next may not look like a crash at all. At least not in the way most people are preparing for. Right now, the media is full of warnings. You hear about a housing bubble. You hear about an overvalued stock market. You hear comparisons to 2008 again and again. And naturally, many people have decided the smartest move is to wait. Hold cash. Stay on the sidelines. Let the crash come first. But here's the uncomfortable question very few people are asking. What if the real risk is not that prices fall, but that they never fall enough for you to get back in? What if the thing you believe is protecting you is actually putting you at the most risk? This is where most financial conversations go wrong. We are always fighting the last war. In 2008, the problem was debt built on top of real estate. Credit collapsed. Banks failed. Asset prices crashed hard. It was painful, but it also reset the system. After the crash, cash was powerful again. If you survived, you could buy assets cheaply and rebuild. That experience trained an entire generation to believe that every crisis ends the same way. First comes the crash, then comes the opportunity. But history doesn't repeat itself so neatly. Sometimes it changes direction. What we are seeing now looks less like a classic collapse and more like a slow shift underneath the surface. Asset prices aren't crashing across the board. Instead, everyday life is becoming more expensive. Savings don't stretch as far as they used to. Salaries struggle to keep up. And yet, many major assets continue to rise, even when the economy feels weak. That contradiction confuses people. It makes them think markets are irrational or manipulated. But once you change the lens, the behavior starts to make sense. The real issue today isn't just markets, it's money itself. Over the last decade, and especially in recent years, enormous amounts of new money have entered the system. Governments have taken on massive debt. Central banks have expanded balance sheets. Trillions have been created to stabilize economies, support markets, and prevent short-term pain. In the short run, this keeps systems running. In the long run, it quietly changes what money represents. When more units of currency exist, each unit has to work harder to maintain its value. That doesn't always show up immediately as dramatic inflation. Often it shows up as asset inflation instead. This is why so many people feel like they are falling behind, even when nothing seems wrong on the surface. Prices don't crash. They drift upward. Opportunities don't disappear overnight. They slowly move out of reach. And this is where the biggest misunderstanding appears. Many people think holding cash is a neutral position. It feels safe. It feels patient. But waiting is still a decision. And in an environment where money itself is losing purchasing power, waiting has a cost. You can already see the effects if you look closely. Certain assets attract enormous amounts of capital, while others stagnate, not because they are perfect, but because they are perceived as better stores of value than cash. Capital isn't necessarily chasing risk. It's running away from erosion. This is why some markets look overheated while others look ignored. It's not always speculation. Often it's protection. When people lose confidence in the stability of money, they start searching for alternatives. Some look for productive businesses. Some look for scarce assets. Some look for systems they believe are insulated from political decisions. Whether those beliefs are correct or not, the behavior itself tells a story. The danger comes when people misinterpret this behavior as a signal that a crash must be imminent. They wait even longer. They hold cash even tighter. And slowly, without a dramatic headline, their relative position weakens. This kind of environment doesn't punish everyone equally. It hits savers harder than speculators. It hurts fixed income earners more than asset owners. And it creates a widening gap between people who adapt early and people who react late. That's why this situation is often more damaging than a sudden crash. In a sharp collapse, the pain is obvious. People know something is wrong. Systems respond. Policies change. Eventually, recovery begins. In a slow erosion, the damage is subtle. There's no reset button, no clear bottom. just a gradual decline in what your money can do for you. This is why waiting for a perfect moment can be more dangerous than making imperfect decisions. Markets don't move on certainty. They move on perception, incentives, and confidence. By the time certainty arrives, the opportunity is usually gone. None of this means panic is the answer. Reacting emotionally creates its own risks. The goal is not to jump blindly into anything that looks exciting. The goal is awareness. Awareness means understanding what kind of environment you are in. Understanding that not all crashes look like collapses. Understanding that sometimes the biggest risk is assuming the future must look like the past. Awareness also means asking better questions. What am I really protecting by holding cash? What assumptions am I making about how this system resolves itself? Am I preparing for reality or for a story that feels comfortable? These questions don't have universal answers. Everyone's situation is different. But ignoring the questions entirely is what leads to regret later. History shows that periods of major transition rarely announce themselves clearly. They feel confusing, contradictory, unfair. People argue about what's happening while it's happening. Only later does the pattern become obvious. We may be living through one of those transitions now. Not a dramatic collapse, but a repricing of risk, value, and time. A shift where reacting late becomes far more costly than reacting early. That's why understanding matters more than predictions. No one knows exact timelines. No one knows precise outcomes. But recognizing the direction of pressure helps you avoid the most common mistakes. And one of the biggest mistakes is believing that doing nothing means nothing is happening. If this way of thinking feels uncomfortable, that's a good sign. Real learning usually does. Comfortable narratives rarely protect you when conditions change. If you want to keep exploring how these shifts work, how incentives shape markets, and how long-term systems evolve beyond headlines, then you're in the right place. Conversations like this don't fit neatly into sound bites, but they matter far more than daily noise. And if you've been thinking about this topic yourself, your perspective matters too. Thoughtful discussion is how understanding grows, because in environments like this, it's rarely the loudest voices that are right. It's the most prepared ones.